Uniformity is a word that often gets thrown around in the world of accounting, but what does it really mean? At its core, uniformity refers to the consistency of practices and procedures that are used in financial reporting. Think of it as the glue that holds the accounting world together. Without it, we would be lost in a sea of numbers, and investors, lenders, and other stakeholders would have no way to make sound decisions based on reliable data. Now, you might be wondering, how exactly is this uniformity achieved? The answer lies in the generally accepted accounting principles, or GAAP for short. These principles are established by the Financial Accounting Standards Board, or FASB, and they provide a framework for preparing financial statements. By adhering to these guidelines, businesses can ensure that their financial information is not only accurate but also consistent across the board. This is crucial because it helps safeguard stakeholders against misleading or inaccurate information. But why is uniformity so important? Well, for starters, it ensures that all financial transactions are reported accurately and consistently. When businesses use uniform accounting methods, their financial statements accurately reflect their overall health. This is vital for investors who rely on these reports to make informed decisions. Moreover, standardizing reporting processes across departments helps avoid costly errors. Imagine if one department recorded transactions one way while another did it differently. It would lead to confusion and potentially disastrous financial decisions. There are, however, some misconceptions about accounting uniformity that we need to clear up. One common misunderstanding is that all transactions must be reported in the same way. That's not quite right. Instead, uniformity means that transactions must be reported accurately and consistently, but the method can vary depending on the nature of the transaction and the type of business involved. For instance, cash sales and credit sales are recorded differently, reflecting the unique aspects of each type of transaction. Another myth is that all businesses must strictly adhere to GAAP. While GAAP is widely used, some smaller businesses may opt for modified cash basis accounting, recognizing income when it is received rather than when it is earned. The key takeaway here is that whatever approach a business takes, it must remain consistent over time to maintain accuracy and uniformity. And let's not forget about the Generally Accepted Auditing Standards, or GAAP. These standards guide auditors on how to check financial statements, but do not dictate how accounts should be set up or maintained. That's up to each organization to decide. Uniformity is achieved when all relevant data is disclosed accurately and consistently across all reports and documents issued by the company. Now, you might be curious about the origins of the term uniformity. It actually comes from the Latin word universes, which means whole or complete. The concept was first used in ancient Roman accounting to encourage standardization in financial transactions. As accounting systems grew more complex over the centuries, especially during the Middle Ages, the need for uniformity became even more apparent. By the 16th century, double-entry bookkeeping was established, laying the groundwork for modern accounting practices. So, how does this all relate to accounting today? Uniformity helps create consistency in financial reporting. By applying the same standards across various companies, investors and creditors can accurately compare financial positions. This consistency is crucial for users of financial data, as it allows them to make informed decisions based on reliable information. Moreover, uniformity promotes transparency among stakeholders. When consistent rules and procedures are in place, it becomes easier to compare one company's financial reports with another's, allowing stakeholders to better understand each company's financial performance. This level of transparency is essential for building trust in the marketplace. Let's take a look at some practical examples of uniformity in action. Preparing financial statements is perhaps the most common application of uniformity in accounting. According to GAAP, companies must use uniform accounting methods when preparing their financial statements. This means that all transactions and accounts must be recorded using the same formats and calculations, ensuring consistency across different reports. Another example is the standardization of business documents. Companies often exchange documents like purchase orders and invoices, but without uniformity, each company might have a different format. This can lead to confusion and errors. By standardizing these documents, all trading partners can interpret them easily, reducing the chances of miscommunication. Uniformity also plays a critical role in internal control procedures. When changes are made to financial records, they must adhere to specific guidelines to ensure accuracy. For example, if an employee alters a customer's balance, that change must follow the organization's policies for recording timesheets and filing invoices. This helps maintain the integrity of the financial data. Now, let's address a common question. Are accounting standards uniform throughout the world? The answer is no, but there has been significant progress toward convergence. The International Accounting Standards Board and the Financial Accounting Standards Board have been working together to promote the harmonization of accounting standards. While differences between international financial reporting standards and US GAAP still exist, these efforts have made it easier for companies to operate globally. Of course, uniformity in accounting has its advantages and disadvantages. On the plus side, uniformity improves comparability, increases efficiency, and reduces costs. When all companies report their financial statements according to the same rules, it becomes much easier for investors and creditors to compare them. This can lead to increased economic investment and more informed decision making. However, there are also drawbacks to uniformity. It can lead to a lack of flexibility, making it difficult for companies to adapt their reporting to fit their unique needs. Smaller organizations may struggle to comply with uniform standards due to limited resources. Additionally, the rigidity of uniformity can stifle innovation, as companies may feel constrained by the established rules. So, why is uniformity important in an organization? It creates equality in the workplace, ensures that all employees are held to the same standards, and fosters cooperation among team members. Uniformity also contributes to financial stability by ensuring regular tracking, reporting, and recording of financial transactions. When everyone is on the same page, it becomes easier for managers to monitor progress and enforce policies. In the business world, uniformity is essential for growth and success. It ensures that processes, procedures, and reporting are consistent, which increases efficiency and builds trust with customers, suppliers, and shareholders. When financial statements reflect consistent operations, they become reliable and accurate, allowing investors to make informed decisions. In conclusion, uniformity in accounting is not just a dry, technical concept. It's a vital component of the financial world that impacts everyone from investors to employees. By adhering to established principles and practices, businesses can ensure that their financial reporting is accurate, consistent, and transparent. This ultimately leads to better decision making, increased trust, and a healthier financial ecosystem for all. So, the next time you hear the term uniformity, remember its significance in the world of accounting and how it shapes the way we understand and interact with financial information.